Can you talk about those kind of pressures on
Yeah.
where we are on that divestment engagement journey?
I think this is one of the trickiest bits to get right, and to be clear, I think that with a lot of the clients that we advise, and for example now pensions that I'm head of sustainability for, we've already advanced quite a far way along that journey. So let me describe a little bit about how we think about the market. I'd say that we'd say 35% of the market is probably contributing to the transition or already operating sustainably. About 45% of the market is what we would describe as adapting, or has the potential to adapt, and we think is willing to adapt. And we'd really love to see those transition plans get more concrete. They don't need to be perfect right now, but they need to be working on them. And we really think that they're on a journey to which has a reasonable endpoint. It's the last 20% of the market that we really struggle much more with, and where in many cases we've already decided that we will no longer invest with them, because having engaged, it's either clear that they are not willing to be adapting to the transition that is needed, or maybe they even say that they are, but their actions clearly demonstrate that they're not. There's substantial risks that they will fail to transition. And when we think about our stewardship, where we want to exercise our resources, they are limited. We want to be engaging with companies where we think we will get change. And we know that in some cases, we're just not going to convince these companies to change. So again, I think what we're trying to do is we are walking along that line of saying, well, there's a decent portion that we are now already deciding to exclude. Other investors exclude far less and say, well, we want to be much closer to the benchmark. And that's, I think, one of the choices that investors really have to make here. And then on the other hand, what can we do about those companies? I think maybe we can do some systemic engagement with governments about how to make sure those companies are required to do some sort of transition. But whether governments get there or not, I'm not quite sure. I think the big challenge is one of time frame. So coming back to your point on fiduciary duty, when you've got some investors who are like by 2050 or 2060, we know that these climate change effects are going to get very much bigger than they are already. And so we know that that's in their interest to decarbonize as quickly as possible. When you look over a 5-year time frame and you say, well, what's in the right interest of my members right now? We really struggle with this question, because while we have disinvested from many of the companies, for example, in the oil and gas sector, we haven't disinvested from all of them. We don't think that the ones we still own have credible transition plans. We've really been trying to engage with them, but we're not making much progress. And so there's this real tension of, do we disinvest completely, but at the same time, the financial risk of doing that, because the world has not transitioned and is not already at a point of saying we don't need fossil fuels anymore. I mean, the end problem is we demand fossil fuels. As consumers, we are still using them tremendously, and so in the end, it comes down to our own actions that we haven't yet progressed to a point where we're saying we're prepared to live in a world that is not using fossil fuels. And so I think there's this real balancing act that we try to get right with our clients of saying, well, we think you should be disinvested from a lot of these, but not all of them right now. And that will probably change over the next 5 to 7 years. But a lot of that does depend on the pace of change in regulation and how quickly we see the world beginning to change.
Do you think there should be a greater emphasis? Maybe we should move some of the government's emphasis away from consolidation and towards value for money, because that seems to be what you're touching on there with that discussion of private assets and all the different aspects that they can give you beyond passive equities just being incredibly cheap and rising because of Trump and the Magnificent Seven.
Yeah. I mean, I think every day it should be value. And so I think if that was my one ask, that would be an amazing vision, wouldn't it? To have decisions made on value and it's focused on net returns and not cost and not scale, but all about value and what you deliver for members. I think that would be hugely positive. I think it's happening, and I think the market's starting to move that way, and I've had encouraging conversations with clients and sort of others in the industry. But I think things like that take time, and we've come from an environment where actually cost was everything, and now we've got to shift it. So I think there's a lot that as the industry will need to do to sort of help that, to educate along the way to and actually demonstrate the value. And that's why I think it's key when we do start going into private assets that actually we do it really well, so that people actually see the value coming out of it, because that's almost the worst that can happen is you make a decision in haste and then repent at it, and actually clients go, well, I told you so, look, you never should have done it. And I think that would be really bad. So I think that's why it's so important to take a bit of time and to do your due diligence when looking at this. But yeah, definitely value every time.
And maybe you have a slightly more limited investment universe than go back to the DC again, because as you said, you ring fence the assets for all of your schemes, but their ultimate goal is buyout. Is that correct? They're never going to, or they're just going to allow you to run on the scheme. So if you've got that very specific goal of buyout in mind, that's going to determine how you invest, because you have to invest in a way that either is very easy to transfer to an insurance company, or an insurance company with its much more prescribed regulatory regime is going to want to pick up on.
Well, that was initially what we thought we were going to do, was that you would effectively invest on behalf of one scheme and therefore transition the assets so that by the time it was ready for buyout, then ta-da, you'd have a matching adjustment ready portfolio to pass over to an insurer. What we found is that we can actually do better than that. Through this private markets vehicle, this internal private markets vehicle, we can generate a better return. And because we can recycle those assets, we can effectively give cash and gilts to the insurer at the end, as long as we've still got the flow of new business to new sections coming in that justify us being able to recycle. So as long as we keep balancing the books, we can actually invest on a longer term strategy. Now that does open up new asset classes. To your previous point, what about infrastructure debt? What about us we'd love to be part of the productive finance agenda. We genuinely would. As an aside, I think that when you remove the complexity of a pension scheme and the ongoing commitment, distraction and cost from a sponsor, you're allowing them to focus on their core business. And by definition, we are dealing with you. Therefore, I hope in a small way we're supporting the productive finance agenda through what we're doing in our day jobs.
How do you think sort of government proposals around LGPS consolidation, what kind of impact is that going to have? To go back also to the news story that we started with somebody like Kensington and Chelsea having a 207% funding levels, because the logical conclusion on that is actually, they wouldn't really have been able, well, maybe they would have been able to do it, but how does sort of bringing more of the investment within a pool and leaving strategic decisions to partner funds, would that reshape what Kensington and Chelsea have been able to do? Does that have implications for other LGPS in terms of how much control they have?
Yeah, it's interesting. It's a hotly debated topic. I think there's an awful lot of not confusion's the wrong word, but the government's going in a certain direction. I don't know where they will land. They are clearly pushing towards consolidation. I think the funds themselves have concerns that some of the things they're used to being able to do, they'll be less able to do in the future should the government push through what is proposed. And let's be honest, LPPI is largely in line with a lot of things the government is pushing towards. So our clients have experienced what the government is pointing towards potentially as that. And our experience is our clients are very happy and don't feel they can't execute their aims. That being too imprecise, but if you look at the performance tables and returns over the last 5-10 years, we're not that far away from Kensington and Chelsea. So it's a case, but with a much broader, more diversified asset allocation. So our clients have been able to do similar things to that. And I'd say that in the case of Kensington and Chelsea, they wouldn't have been able to. I don't know where it goes. They may not have been able to do exactly what they've done. And I know they were certainly pushing back, but could they have had a broadly similar asset allocation? Absolutely. So if you look at what the government is proposing, they are proposing one version is to leave the asset allocation with the funds, and this idea that the funds will lose local accountability from pooling, I don't really see it that way. I don't see our clients having any loss of local accountability due to essentially us acting as their fiduciary and implementing their portfolio. And we've designed a structure to be sympathetic to that. The real local accountability comes from setting contributions and owning the overall risk profile, which our clients have done, and I don't see that changing. So I think it's one of those ones where it is debatable. It is change, but I'm not sure it's quite as big a change as is being thought about in some ways. But I do think this Kensington Chelsea, the proposal to change the contribution rates is interesting. It's meaningful. I don't quite know how it plays out. I don't know how government will feel about it and how they may respond. We'll see. But it does feel like an interesting move in the game of 3D chess that we're all playing at this point in time.
Do you think some of it has got to do with quality of data, that we just don't really have enough data about it, that just sort of like raw numbers isn't really reflective? To touch on what you were saying before, just because you have greater diversity doesn't mean that you've had a major cultural shift or anything like that. You know, you may just be turning out patriarchal mini-me's in, you know, in female form, if you see what I mean.
Oh yeah, I know exactly what you mean, and it's the irony of it, isn't it? And that the way we talk about diversity is kind of a diversity fail in itself, because most of us in this industry, myself included, are numbers people. We believe that what's measured is managed. You know, we want to see everything reduced to data, to charts, to spreadsheets. That's what we're comfortable with. I know I'm totally guilty of that myself, but it means that we're not really understanding or looking at the nuances of the equity and inclusion part of diversity, of DEI, and particularly inclusion. I mean, that's really hard to measure. You're talking about culture and how people feel. And I think that can feel very uncomfortable for a lot of us who are used to just, you know, reducing everything to numbers. So I think, yeah, it is a huge issue. And for me, I personally have to try really hard to see outside the numbers and, you know, think about nuance a bit more than I probably naturally do.
One of the things I think you touched on before, which I think I kind of like to end towards, at least, you talked about the triple T. One was tariff, one was Trump, and I've forgotten the third. And you mentioned how stock markets other than the US has actually been performing quite well, which hasn't happened for a very, very long time. It's almost, as you know, intangible as value outperforming growth, which hasn't happened for a very long time either. But has Trump sort of like, is it to be quixotic, has Trump done Europe a favor and actually made us look sort of moderate and calm, and our stock markets have performed better going as a result? And how do you see that kind of unfolding onto the, I mean, I'm not going to ask you to predict what Trump's going to do, because even Trump doesn't know what Trump's going to do. But can you see that kind of like volatility and sort of ebbs and flows between relative performance between Europe and the US continuing over the next 4 years?
Well, one of the other stories I was considering for today's discussion was actually around the sectoral outperformance of defence as a sector. And there are a number, clearly, of very large defence stocks within Europe and indeed within the UK. So if we think about a number of names there, they have done very well over the past little while. Now, that is and can be viewed as a reaction to the geopolitical environment that we are in currently, and some of the risk which is being priced in there. So I think there is something around sectoral composition, Charlotte, within European indices, for example, and that is coming through very much in those sectors. So you're absolutely right around the difficulty of predicting what the next moves will be. So it is natural, of course, for investors to look for what may deliver more stable long-term returns. We also have a bit of a lens of how the dollar has been behaving over the past 8 weeks or so. So that is an important factor as well for global investors that are seeking to mitigate some of the dollar volatility risk that they're seeing as well.
So talk to me a bit maybe about the sort of the structure and the operations of it, because I know that you're not this size, but if I were a typical 25 billion scheme, my kind of like minimum allocation to any asset class is probably going to be around 5%, because it's not really worth my while investing a lot of time into something unless I'm going to allocate 5%. 5% for a 125 billion scheme, and you'll correct me if my maths is wrong, I know, Veronica, is about £1 billion. So is there enough liquidity? Is there enough in the pipeline within the UK? And of course, we don't have to allocate just to VC. We don't have to allocate just to the UK. how should pension schemes be thinking about that kind of allocation to VC? Where should they be looking regionally, and where should they be looking along that investment curve from startup to large buyout on private equity, and where does VC fit into that?
So I'll go to the last question first, because I think we should think about the whole stack, because again that aligns with the members' time horizons, but also overall we should probably try to give the members the access to just the whole industry, and from the diversification point of view, from the returns point of view. In terms of the allocation, I would actually disagree here, because I think everyone who's thinking about this will be thinking about kind of diversified private markets portfolio. Separate allocations there will be smaller than 5%. And if our goal is to build out properly diversified, well-positioned private market sleeve, then you will have lots of different things there. So currently we do have 5% target allocation in private equity, but it consists of also different sleeves. So there are different ways you can do it, but we are looking currently at about 2% allocation to venture capital, in addition to the 5%, around 5% allocation to private equity. None of this can happen straight away. So all of these are target allocations that will be built out gradually. So I'm totally with you that if you say like tomorrow we allocate 5% or even 2% to asset class X, which is illiquid, newly emerging with new managers, like it can't happen straight away. So you need to make sure the plumbing work, you need to do all your due diligence, they need to find the correct investment opportunities if you're going through different managers. So it is a process, and we're working with our trustees, we're working with our investment consultants, who also are emphasizing that this is a process. So we're also growing quite fast. So whatever we're allocating now will be a smaller percentage later on. We just need to get on with it.
Let's go back to inflation and emerging markets and manufacturing. Obviously, the big story since the 20th of January when Trump got elected is Trump's tariff war, or is it a tariff war, or should we say Trump's volatility around tariffs? Are they on, are they off? And that in itself, I think you talked about geopolitical risk, that in itself has the ability to be inflationary and to have impacts maybe long term, who knows, on sort of manufacturing. So how are you thinking about those kind of geopolitical sort of fundamental shifts and the impact that could have on inflation and long-term interest rates?
Yeah, I mean, a couple of dimensions that come to mind. And look, I will claim no ability to predict the near-term policy direction from various administrations. So I think we just take that as a given and say, well, how do we kind of build portfolios around it that can withstand that degree of volatility? It does. I mean, I think it plays into the theme that we talked about, is some of the trend around deglobalization, some of the trend around nearshoring, onshoring. We do think that lends itself to being structurally inflationary. There is also a dimension here of inflation. I mean, we talk about, and I think it's easy for us investment professionals to talk about the headline inflation. But clearly there is an aspect of the headline inflation as an average. It's felt differently in different strata of the consumers. And what does that mean? I mean, we have seen the cost of living crisis debate here in the UK. What does that mean for essentially the solutions that we provide as investment, savings, wealth and retirement providers? So I think that's where we lead into my personal view. I do think inflation is a bit of a sticky problem, won't always remain kind of linear at same level, and we will see ups and downs. But I think there is a degree of structural challenge. It does also, I mean, I guess just to complete it, I think there is also a bit of a positive aspect I tend to be an optimist, so I thought I'll end on a positive note. There is a positive aspect to this. I mean, we have seen some of the emerging discussions at a policy level here in UK, more broadly in Europe, on how do we invest more in local economies, how do we channel investments. And that's where I view is if there is a silver lining from the current policy debate, I think that probably provides pretty attractive investment opportunities for us.